is run by a bunch of investment bankers, and Morningstar's tools can help make
I'm Jason Stipp from Morningstar. It's Asset Allocation Week on Morningstar.com, and today we're talking about managing your allocation. Now, there are, of course, several ways you can go about this, but you could say that there are two broad approaches: a strategic approach to asset allocation, and in this approach you may own stocks and bonds and perhaps shift more toward bonds as you get closer to needing your money. There's also another approach called tactical asset allocation. And in this approach, there may be some trimming of some overvalued assets and some purchasing of some undervalued assets in order to be more opportunistic in the market. I'm happy to have with me today Rob Arnott. He is chairman and founder of Research Affiliates, also a manager of PIMCO All Asset and All Asset All Authority, and a past editor of the Financial Analyst Journal. Now, he is a practitioner of the tactical asset allocation approach, a successful practitioner, and he's here to give us a few details about that approach. Thanks for joining me, Rob.
It's a pleasure.
So the first question for you is sort of a timely one. A lot of folks who had practiced a traditional strategic buy and hold approach really felt like they were burned in the downturn when everything seemed to go down. And it seems like a lot of folks are saying now, questioning whether this approach is viable. Looking forward, would you say that there is any application for that traditional strategic asset allocation approach for investors in the future?
Well, the essence of asset allocation is the management of your diversification. To do this, you have to have an awareness of your appetite for risk, and risk should be defined not in terms of normal volatility of various markets, but really worst-case scenarios. Could you stand the worst-case scenario? If you can't, you'd better use a lower-risk portfolio. The other element here is an awareness of the return opportunities. It's well known that the markets don't reward what's comfortable, what's popular, what's trendy. Those are the assets that have enjoyed past rewards. They're already priced to reflect an expectation that things will go swimmingly for them. And if they don't go swimmingly, those assets are the first to tumble. So an awareness of return opportunities is also very important. And unfortunately, that requires setting aside human nature. Human nature conditions us to do what's comfortable, not what's profitable. Conditions us to go where the crowds are, where friends and colleagues are investing, not into segments of the investment world that people are shunning. And a simple answer to your question is, for those who can't do tactical asset allocation right, for those who don't have the courage to buy what's out of favor, to buy what's unloved, then rebalancing to a static target mix absolutely trumps buy and hold, and even more so trumps chasing whatever has recently been successful. Russell Kinnell, one of your top research people, wrote a wonderful piece a few years back called Mind the Gap that shows that most investors do the wrong thing at the wrong time and chase whatever has recently been successful, and that it costs them 2 to 3% on their return on their portfolios per year, compounded over long periods of time. It's a horrifying bit of damage. So, short answer to your question, a strategic asset allocation approach makes a lot of sense for those who want an anchor for rebalancing. It makes less sense for those who can be tactical and who can pursue opportunities in markets that are out of favor and attractively priced.
Now, with a strategic approach, you may say, I might rebalance once a year to get back to my targets, or I might start to move my allocations to be more bond heavy as I get a little bit older. When you're making decisions about when to buy and sell in your portfolio as a tactical practitioner, what sort of things trigger you to take a look at your portfolio, to take a look at the opportunities out there? How do you know when to take action?
Well, the triggers aren't time. Annual rebalancing or quarterly rebalancing seems to suggest something magical about a particular date on the calendar. The date on the calendar is not relevant. People say that in real estate there are three things that matter: location, location, and location. In asset allocation, there are three things that matter: valuation, valuation, and valuation. Buying what's cheap and what's out of favor and what's a little frightening to buy tends to eventually be profitable with the courage to weather a bumpy road. Selling what's popular, trendy, comfortable, and expensive tends to be beneficial for those with the courage to shrug off any continued rallies in the assets after they sell them. After considering valuation, maybe macroeconomic factors can come into play, and maybe factors about what's going on in the world that valuations would miss can come into play.
At Morningstar, we feel it is important to schedule regular checkups of your investments. This is the reason we're pleased to announce Portfolio Monitor, a new and easier way to keep track of your investments. With a few clicks of the mouse, receive a monthly report that provides a comprehensive and customized summary of your portfolio, sent automatically to your inbox. Portfolio Monitor provides a concise digest of all the best features of premium membership. Become a premium member with our 14-day free trial to start receiving Portfolio Monitor today.